If you happen to be in business of shipping or air transport, then this section of Nigeria's Companies Income Tax Act is for you. In this video, we are diving into section 14, where we uncover the fascinating world of taxation for companies engaged in shipping or air transport. From the bustling ports to the skies above, this section ensures that every aspect of international transportation contributes its fair share to Nigeria's economy. Stick with us as we unravel the complexities to shed light on these crucial aspects of Nigerian tax law. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Section 14. Companies engaged in shipping or air transport. Where a company other than a Nigerian company carries on the business of transport by sea or air, and any ship or aircraft owned or chartered by it calls at any port or airport in Nigeria, its profit or loss to be deemed to be derived from Nigeria shall be the full profit or loss arising from the carriage of passengers, mails, livestock, or goods shipped or loaded into an aircraft in Nigeria, provided that this subsection shall not apply to passengers, mails, livestock, or goods which are brought to Nigeria solely for transshipment or for transfer of one aircraft to another, or in either direction between an aircraft and a ship. For the purpose of the preceding subsection, where the service is satisfied that the taxation authority of any other country computes an assess on a basis not materially different from that prescribed by this act, the profit of a company which operates ship or aircraft, and that authority satisfy the ratio of profit or loss before any allowance by way of depreciation of an accounting period to the total sum receivable in respect of the carriage of passengers, mails, livestock, or goods, and the ratio of allowance by way of depreciation for that period to that same total, then the full profit or loss of that period shall be taken to that proportion of the total sums receivable in respect of the carriage of passengers, mails, livestock, or goods shipped or loaded in Nigeria, which is produced by applying the first mentioned ratio to that total, and in place of any allowances to be given under the provisions of second schedule, there shall be allowed the amount produced by applying the second mentioned ratio to that same total. Where at the time of assessment, the provisions of subsection 2 of this section cannot for any reason be satisfactorily applied, the profits to be deemed to be derived from Nigeria may be computed on a fair percentage on the full sum receivable in respect of the carriage of passengers, mails, livestock, and goods shipped or loaded in Nigeria, provided that where any company has been assessed for any year by reference to such percentage, it shall be entitled to claim at any time within 6 years after the end of such year that its liability for that year be recomputed on the basis provided by subsection 2 of this section, and where such claim has been made and a certificate has been produced to the satisfaction of the service as provided in that subsection, such repayment of tax shall be made as may be necessary to give effect to this provision, save that if the company fail to agree with the service as to the amount of the tax to be so recomputed and repaid, the service shall give notice to the company of refusal to admit the claim, and the provisions of this act with respect to objections and appeal shall apply accordingly with any necessary modifications. For the purpose of this section, the tax payable by any company for any year of assessment shall not be less than 2% of the full sum receivable in respect of the carriage of passengers, mails, livestock, or goods shipped or loaded into an aircraft in Nigeria. notwithstanding the provisions of any other section of this Act, where any company files tax returns under the provision of subsection 3 of this section and does not provide a separate financial statement of the Nigerian operations for the purpose of filing its tax returns, such company shall submit detailed gross revenue statements of its Nigeria operations showing the amount of full sums earned during the period, certified by one of the company's director as well as their company external auditor, and supported with all invoices issued to the relevant customers. The provision of this section do not apply to income from leasing containers, non-freight operations, or any other incidental income liable to tax under Section 9 of this Act. Regulatory agencies in the shipping and air transport and other relevant sectors shall mandate all companies taxable under the provisions of subsection 1 of this section to present the following: evidence of income tax for the preceding tax year and tax clearance certificates showing income tax paid for the 3 preceding tax year in order to continue to carry on business in Nigeria or obtain any relevant approvals and permits. Interpretation, analysis, and case studies of Section 14, subsection 1 to 2. This section of the Nigerian Companies Income Tax Act outlines the tax rules for companies engaged in shipping or air transport. It states that if a company which is not based in Nigeria operates ships or aircrafts and makes a stop at a Nigerian port or airport, the profits or losses deemed to be derived from Nigeria will be the full profits or losses from the transportation of passengers, mails, livestock, or goods loaded or shipped in Nigeria. However, this rule does not apply to items that are brought to Nigeria exclusively for transshipment or for transfer between different aircraft or between an aircraft and a ship. Analysis. This section of the law deals with the taxation of non-Nigerian companies engaged in the business of transport by sea or air. It specifies the circumstances under which the profits or losses of such companies will be attributed to Nigeria. The provision sets out a formula for calculating the portion of profits or losses attributable to Nigeria based on the activities conducted within the Nigerian territory. The provision aims to ensure that non-Nigerian companies engaged in shipping or air transport pay taxes on the income generated from their activities in Nigeria. Case studies. Case study 1. XYZ Air, a non-Nigerian airline company, operates regular international flights. During its operation, XYZ Air makes a stop at Muritala Mohammed International Airport in Lagos, Nigeria. While in Nigeria, the airline transports passengers and cargo, generating revenue from these activities. Under the Nigerian tax law, the profits or losses derived from the carriage of passengers and goods loaded in Nigeria will be subject to taxation in Nigeria in accordance with the specified formula. Case study 2. ABC Shipping, a foreign maritime transport company, operates a fleet of cargo vessels. One of its ships dock at the port of Lagos, Nigeria to load and unload goods for international trade. The profits or losses attributed to the transportation of goods loaded or shipped at Nigerian ports will be considered as derived from Nigeria for tax purposes, as per the rules outlined in the Nigerian Companies Income Tax Act. In these case studies, the application of Section 14 of the Companies Income Tax Act would result in the calculation and taxation of the profits or losses attributable to the activities conducted by the non-Nigerian transport companies within Nigerian territory. Interpretation, analysis, and case studies of Section 14, subsection 3 to subsection 6. Interpretation. If for some reason the specific provisions in subsection 2 cannot be applied, profits derived from Nigeria can be calculated as a fair percentage of the total amount received for transporting passengers, mail, livestock, or goods from Nigeria. Any company that has been assessed using this percentage can request a recalculation of their tax liability within 6 years after the assessment. If the company and the tax authority cannot agree on the recalculated amount, the company has the right to object and appeal the decision. The tax payable by any company for transporting passengers, mail, livestock, or goods in Nigeria cannot be less than 2% of the total amount received for these services. If a company files tax return under subsection 3 and doesn't provide a separate financial statement for its Nigerian operation, it must submit detailed revenue statement for its Nigerian operation certified by a company director and external auditor along with all supporting invoices. These provisions do not apply to income from leasing, containers, non-freight operations, or other incidental income that is taxed under Section 9 of this Act. Regulatory agencies in shipping, air transport, and related sectors will require companies subject to these provisions to provide evidence of income tax filing for the previous tax year and tax clearance certificates showing income taxes paid for the previous 3 years in order to conduct business or obtain relevant approvals and permits in Nigeria. Analysis. This section of the tax law is concerned with the taxation of companies engaged in transporting passengers, mail, livestock, or goods in Nigeria. It provides guidelines for computing the profits deemed to be derived from Nigeria when specific provisions cannot be applied, sets a minimum tax payable, and outlines the requirement for tax filing and documentation for companies operating in the relevant sectors. The provisions allow for the computation of profit based on a fair percentage of the total amount received for transportation services when the specific provisions of subsection 2 cannot be satisfactorily applied. This provides some flexibility in determining taxable profits in cases where the standard method is not appropriate. The requirement for detailed revenue statements and certifications from company directors and external auditors under subsection 4A aims to ensure transparency and accuracy in the reporting revenue from Nigerian operation. The exemption of certain types of income from these provisions, as stated in subsection 5, indicates that the law seeks to focus specifically on income derived from the transportation of passengers, mail, livestock, or goods in Nigeria. Finally, the provisions for regulatory agencies to mandate tax filing, evidence, and tax clearance certificates from companies in relevant sectors reflect an effort to strengthen tax compliance and ensure that companies meet their tax obligations to ensure operating or receiving approvals and permits in Nigeria. Case studies. Case study 1. Airline company. If an international airline company operates flights to and from Nigeria, transporting passengers and cargo to and from Nigerian airports, it would fall under the provisions outlined in the tax law regarding the taxation of profits derived from transporting passengers, mail, livestock, or goods in Nigeria. If the company faces challenges in applying specific provisions for computing taxable profits, it can resort to calculating profit based on a fair percentage of the total amount received for these transportation services. This flexibility allows the company to determine its tax liability in a manner that is suitable for its operation in Nigeria. Additionally, the company must ensure that its tax filing includes detailed gross revenue statements of its Nigeria operations certified by a company director and external auditor, along with supporting invoices. These requirements are crucial for the accurate reporting of revenue from Nigerian operations as mandated by the tax law. Case study 2. Shipping company. Consider a shipping company that operates cargo vessel conducting international trade to and from Nigerian ports. The company operations involve loading and unloading goods in Nigerian ports, which fall under the provisions of the tax law related to the carriage of goods in Nigeria. As per the tax law, the company must ensure compliance with the minimum tax requirements of 2% of the total amount received for the carriage of goods in Nigeria. This ensures that the company contributes a minimum level of tax revenue from its shipping operations even when facing fluctuating profitability. Furthermore, the regulatory agencies in the shipping sector may require the company to provide evidence of income tax filing for the previous tax year and tax clearance certificates for the preceding 3 years as a condition to continue its business operations or obtain relevant approvals and permits. In both case studies, the tax law's provisions are designed to ensure that companies engaged in transporting passengers, mail, livestock, or goods in Nigeria comply with tax regulations, report their revenue accurately, and contribute to the country's tax revenues. In essence, Section 14 of Nigerian Companies Income Tax Act play a vital role in ensuring fairness and transparency in taxation for companies engaged in shipping or air transport. By attributing profits or losses to Nigeria based on specific criteria, this section ensures that international transportation companies contribute their fair share to the Nigerian economy. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.